Welcome to the Retiring Real Estate Investor podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello, everyone, and welcome to another episode of the Retiring Real Estate Investor podcast. I'm your host, Brandon Bruckman, and I'm excited to be joined today by Dr. Sanjay Sharma of the president at Exponential Capital Investments. How are you, sir?
I'm very good, Brandon. Happy to be here. It's an honor to be here and be on your podcast. I'm excited.
I made a joke before we started recording. I think you immediately took off. You saw your last patient for the day before we hopped on. So I was thinking in my mind, I'm sort of interrupting your day here. We might be postponing a surgery, but we found you in time to hop on.
You timed it well. You timed it perfectly.
There we go. So maybe let's start here. We did have a little pre-conversation about fit, and you shared some really interesting stuff with me. Let's start at the beginning. Where are you coming from? What are you working on now? Give our listeners an idea of who you.
So asked about the past, present, and future, huh?
A little bit, yeah. Love it.
Yeah. So part of my future, obviously, is I am a doctor. I'm a physician, but my identity is primarily, based on this podcast, is a multifamily real estate syndicator. So my group, my team, we purchase multifamily properties throughout the countries and emerging markets and bring our investors in, oftentimes physicians and high net worth executives, to bring them back double-digit returns and double their money in 5 to 7 years. And, like your podcast is saying, retire through real estate at a better point in their life, if you will. You asked me about, so that's my present, and that includes my future. And then in the past, so I was a doctor before I was a real estate person. So I got my feel just kind of in observations from real estate, like most people do. They see that properties go up in value. You hear about people making money in properties, and you're like, that's kind of interesting. But it's not necessarily something tangible in the sense of, unless you are exposed to it, unless you're kind of mentored into it, it's not something that you necessarily do. It was still traditional 401k, even during residency. We weren't even guided on that, but my dad always told me, make sure you put money away in retirement. So okay, fine. That's kind of what we did. And then seeing kind of the real estate go up, I did some of my training in New York City, which was my first eye opening when you were looking at triple digits, or I should say, from investments going from 5 digits to 6 digits, not mine, but seeing the properties around, I kind of got a feel from it. My wife is from LA. We moved to Southern California, and likewise on this market, it's similar. I still kind of shied away from it. Then I started getting involved as a limited partner, purchasing in big buildings. And again, I still didn't get the concept. Like New York was a great example for me when I was living in an apartment, and I was too nervous to buy an apartment because I didn't know what I was doing, and the prices to me were astronomical. I think 2 bedrooms at that time were going for, I think, like $600,000, something like that, which was more money than I could have ever imagined doing. And someone's like, well, you need to buy the building. And I literally said to myself, like, no one buys a building. Like, who buys a building? I buy buildings up, but no one buys a building. Like, the concept was just so foreign to me. So anyway, I started doing limited partnership where we started buying buildings. Still had no idea what I was doing. I didn't get great teaching, great mentorship, but I was just like okay, everyone else is doing it, so maybe I should try it. Um, so I did some limited partnerships. They went very well. I did a few more, and then I recognized that I could do this on my own. I started doing active investing in smaller units, all in LA. So 2 units and 4 units, triplexes, built ADUs. Was very successful, but it wasn't giving me the true freedoms that I was searching for. And then that was my transition into syndications.
It's very interesting to think about making that transition. You did this very thoughtfully, and I would imagine that part of the challenge is you do have a full-time and challenging job, and you mentioned a lot of your investors are coming from your same field as well. Talk about some of the challenges they're facing, and let's say their investment journey as a doctor or physician. What sort of challenges are
Yeah.
they facing, and how are you guys able to help them?
Yeah. Yeah. So I would say kind of one of the biggest challenges physicians have is the way we think. We are super, super analytical. Uh, I'm an oncologist, so specifically in oncology and in cancer, we are hardcore with data. When I'm prescribing chemotherapy or any biologic treatments, I know the benefits. I know the statistical nuances on how that particular drug worked and the mechanism of action. So if you get too analytical in terms of investing in a space where you may not be as comfortable in, it can kind of freeze you. So
Mhm.
I think that's it. I think that's a big issue for doctors in terms of investing in real estate. And like you said, like I had kind of had a thoughtful pattern. A lot of that thoughtfulness was hours and hours of readings and podcasts and stuff like that. One thing doctors are good at is study. So I study the whole heck out of this.
Yep.
And so and in fact, that probably delayed my. I wasn't the type back then to just say, okay, fine, let me just kind of do it, even though I said I did it. But that was through years of researching. So there's the analytical side of this. There's two also going with the analytical side is we naturally doubt things. We are again we're trained if you're looking at a diagnosis, you also have to think of the differential. What are these six other things that it could be? What are the side effects or the consequences of the things that you're going to do? So we're naturally um, going to be a little bit wary of jumping into things. Thirdly, we've been told and we get approached by a lot of people who will sell us things. So there's also like, do you trust um, who's selling this to you? Are they really like blowing smoke in your face? Um, and then and then I think the other thing is now in medicine, it's most of us are not entrepreneurial. Most of us are W-2 workers. So we have the same things that everyone has with a job. You have your W-2s, putting money away. Um, and then if you step back and then you start to recognize, and this is a talk I have with my investors a lot, is where do you see yourself 10 years from now, 20 years from now? Literally this morning, I was having a discussion with two people. One person was telling me that they were 64 and they're going to retire next year. And between he and his wife, that they had made decisions throughout their life in terms of their expenses and how they invested in their pensions, that they're going to actually make 100% of their income right now. I was like, okay, you won, you did it right.
Mhm.
And then I congratulated them. And at the same time, I talked to a younger physician. I said, hey, okay, let's talk about this for a second. And they did it perfectly right, except they're seeing an oncologist, so they're seeing a cancer doctor. I was like, what if you can do what they were doing at 55 years old? What if you could do it at an earlier space? It opens up so many opportunities for you. You
Mhm.
can continue to work as many hours as you are now. You can continue to see patients. You can go take care of your parents. You can go travel. You can do your charity work. You can just do a whole lot more. And ultimately, you become a better person and you become a better doctor. Once you take kind of the financial freedom and I can bring it to my investors and to my physicians, I am then helping create a nation of um, better doctors. You, as a patient, if you're seeing a doctor, you want your doctor to be fully focused on the medicine that's in front of them and not have any exterior stressors. And real estate is one way to get it there. So, I mean, to surmise your question, like, what are the things I see with my physicians? So, analysis paralysis, introducing a new topic, uh, recognizing what real estate is, understanding what their current state is in terms of the finances, and then working with them and helping them kind of alter that mindset, or I should say, not alter. Alter is not the right word, but to work on that mindset, to flourish that mindset, so that they can recognize what are the different freedoms that they are searching for,
Mhm.
and real estate asset class is something that could help them get there.
Gotcha. No, that's perfect. I think here's a layman's stereotypical outside perspective. You're a
All
doctor,
right,
you're a
fair enough.
physician. You're a doctor, you're a physician. In my mind, you're rich. Why do you worry about finances? That is way
Yeah.
off base, isn't it? Right?
Mhm.
There's a
Yeah.
lot more going on there. Can you unpack how that's wrong for our
Yeah.
listeners? This is actually much more of a
Yeah.
challenge for physicians than I give it
Yeah.
credit for.
Yeah. So that's kind of funny. So I'll tell you an example. We were at Best Ever Conference this past spring, and there was a physician component for the first time there.
Oh,
And,
cool.
I, and we were kind of like off to the side in the corner. And I was like, I bet you these people don't get us. Like,
Mhm.
who are these people? Because we were literally off in the corner, like by the bathroom, and like, why are all these doctors here? And I would come up and ask and network and talk like normal real estate. And yeah, I would kind of get sometimes I would get looks like, what are you doing here? Although at the same time, most of the syndicators they had physician investors, so
Mhm.
they could get who I was. But I mean, all right, so let's talk about this. Like, the what you're talking about. Okay, yeah, the stereotype that doctors are rich. So we do make more money than many other jobs. There's no question about it. There is, uh, like I said earlier, we are all still we're a service industry. We still have a job. We still clock in, clock out. We still have a W-2. We still have the same pros and cons that everyone who has a W-2 in the US has, in
Mhm.
terms of bosses and hours. One thing that is true for doctors that we've seen a lot is a loss of autonomy.
Mm.
Our voice, our decision making process is now um, uh, lower down on the scale.
Mhm.
It's the payers, it's the hospital groups, it's the administration who has kind of like the biggest say. We were trained as doctors in my generation, and actually all generations, is that patient comes first no matter what.
Mhm.
But the reality is that's not the case. It's the other forces. It's, what are the rules? What are the administrations? And that pulls on a doctor. We don't necessarily do the things that we want to do. And it really pulls on our patients. And the onus comes down upon us. It's almost like if you think about the capital stack in terms of a syndication.
Mhm.
On the bottom of the capital stack is, the mortgage, and then you have, like, your Series A investors, B, et cetera, et cetera. We're not the biggest on the capital stack, and the patients are definitely not aren't the most important. And now I'm kind of being extreme, but right, but like a lot of doctors, if they would hear this, they would understand it. That kind of leads to moral injury for physicians, and a lot of physicians have burnout. So there's an autonomy discord there, where what you trained and what you went into this uh, at the beginning is different than what you see in reality.
Mhm.
Um, and then two, there's certain freedoms that we all seek, that we can't necessarily get unless we find different avenues of seeking financial independence at whatever salary that you're at.
Mhm.
A third thing that people also talk about is we enter the work field kind of at well, maybe an older age. I think I started practice when I was, I think, 35. That was like my first like real paycheck. So
Oh, wow.
as opposed to my investment banker friends in New York who in their 20s,
Mhm.
they were seeing that, which gives them another 10 or 15 years of income. Lastly, we all have, I mean, I don't at this point in my career, but a lot of people have several $100,000 of student loans.
Mhm.
And then lastly, we're kind of catapulted into the world not knowing what we're doing in terms of finances.
Yeah.
So in a lot of respects, we straight up are a service oriented business, and we're like every single other person in
Mhm.
the country. Yeah, we have a higher salary. That's it.
That's very fascinating. And I think there's a lot of things to sort of unpack there and to kind of combine with your first answer too is I think what I hear, and and I am a little biased. My uncle is a physician or a retired physician, so I see this in him too. Is I do think because you guys are so intelligent and so analytical, I think I think you guys think you can do it yourself. And
True.
there's a lot of do it yourself in this
Yeah.
component too. And then all of a sudden you wake up and you
Yeah.
go, wait, I'm dealing with these big headwinds. Like one, I might have student debt. Two, I'm behind because I'm starting later than everyone else. And three, I don't have time because your job is tremendously more challenging and taxing than, gotta be honest, like I've been there too, like a typical W-2 worker. I could find ways to sort of automate my way around and like save a lot of time at my job during the day and work on other
Mhm.
things. You don't have that option, right? There is no workaround, right? You got to go and do the work. It's a service business as you stated. So it sounds like, is that
Mhm.
fair? Kind of like summarize those things, like the combinations of
Yeah.
those things make it very challenging to kind of ensure your
Yeah.
financial future despite the higher salary.
Yeah. I agree. I think that was a fair statement. Yes.
Very interesting. All right, so let's talk a little bit about what you're doing on the syndication front. When we
Yeah.
pre-spoke, we talked a lot about we talked a little bit about some of the markets that you're looking at. Can you walk our
Yeah.
listeners through that, the markets you got your eye on?
Yeah. 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 I'll tell you the markets that we're in. So, we have properties in Southern California, so LA and Orange County. Well, no longer in Orange County, but LA. We have properties in Atlanta. So, since I'm from here, the first thing I always get is, "What? You're in California? What are you doing in California?" But I'll tell you, you can be extremely successful in Southern California and LA, as long as you know what you're doing. Since I live here, yeah, it's tangible to me. I know where the streets are. I know what I'm doing, and I know how to make money here. I know how to landlord. I know who to partner with, all that kind of stuff. Um, we are in Atlanta because of the market and the economics there, which are just profound. I mean, they're amazing. Uh, and so you can bring excellent returns. So we're even though I said we're in LA, even though we just closed on a property in LA, we've got kind of our eggs in the southeast. We like the Atlanta market, and we are also exploring parts of Indiana. We were part of a deal that was um, uh, very profitable in kind of the South Bend Goshen area near Notre Dame. I think, yeah, Notre Dame. So there is a, I mean, it's like any market has deals, right? Any markets could be incredible. It's you just gotta kind of get in there and learn it and know the right people. So right now, I would say we're focusing on Atlanta and Indiana,
Yeah, I mean it's probably the most interesting mix of markets in one
right?
place that I've ever heard. So
Uh-huh.
and it is interesting, and I would very much agree with you that if you're an expert in given market, you're going to find opportunities one way
Yeah.
or the other, right? So when you think
Mhm.
about LA, I
Yeah.
think there's a misconception here too about the tax situation. Can you talk a little bit about what that means from a property tax side? That it isn't as bad as maybe most folks think it is.
Well, so specifically in property tax, well, I'll start out by saying everything in LA is expensive. I think what you're alluding to is in some other parts. A lot of people talk about Texas. That down in Texas, there's big time property tax increases, and I'll tell you when we underwrite some properties. I have underwritten some properties in Texas. That plays a much bigger role than I would have expected. I'm used to seeing. I mean, the other thing is insurance. I mean, insurance, all throughout the Southeast and the Smile Belt has drastically changed for people. So, so I mean, it's just a bigger expense. But again, it's like you're saying, it's when you're when you're when you're in a market, you need to recognize what all of those things are. To simplify it to the greatest degree is when you're underwriting, everything is a row and a column. Like, what is the number that you're going to enter in there, and how does that pan out in terms of the investment returns? So you have to mitigate all of those stuff. Okay, so if for example, if insurances are going up here, well, are there other places where it makes up? Can you still increase your net operating income even though your expenses are going up? And so you have to kind of look at the whole stall.
In maybe we'll take this market by market, but let's say in LA, what are those key things that you're looking for? Like archetype a typical project that you would find attractive? Is it heavy value add? Is there certain areas? What makes a
Yeah,
project? What do those typical projects look like? Let's say in LA, and then maybe take us market by market if that's different.
yeah. So LA is for us is value add. You like most places in the country, it's you can't buy a fully redone, fully rehabbed building and expect to get significant returns. You've missed the boat. So it's value add. We don't do core plus. We do value add, and oftentimes it's heavy lifting. It's we've had buildings where rents were under $1,000, but we recognize market rents were 3,000. So it's redoing those properties and getting them up there. Sometimes that happens purely because of um, gentrification,
Mhm.
that you're on the massive path of growth. Usually we don't see, or where we've invested, it's not a little growth. It's not like, oh, hey, cool, a Starbucks open there. It's like,
Mhm.
people are shopping at Whole Foods, and people have incomes of several $100,000, and it's those people we're bringing into those properties. When there's those type of neighborhoods, those are very coastal. You're biking to the beach or walking to the beach, that
Mhm.
kind of stuff. And then there's also the markets in which are um, lack of affordable housing, and then you start partnering with different institutions to bring grant monies in to get people who wouldn't
Mhm.
afford those houses anyway to support those rents.
Mhm.
And but still, you're making a very, very good product. The products that we're making are essentially brand new: flooring, HVAC, the whole bed, the whole kitchen, bathrooms, all the kind of stuff. So it's just a brand new stellar product where someone outside of LA would be like, "Oh my goodness, that's like a B or a C class. Why are you putting all of that in there?" Is because you can provide for your tenants and you're getting the returns that you're seeing. And then you start getting, 40% returns, 50% returns. They're quite phenomenal in those first couple of years when you can triple rents.
Mhm. Same sort of setup that you're looking at in Atlanta, or has that become different?
That's kind of a different market for us.
Yeah.
We don't want to do as much heavy lifting.
Mm.
That's when we start. We still sit in the value add, but we try to get closer to the core plus. Uh, so we don't want to rip everything out. We don't want to redo electrical on a big old building, or redo the pipes on a big old building. That's big time capex
Mhm.
cost. So it's a different model. Also, we're also here local. So, if you're doing that much construction and you can drive to it, even though we have teams in these other locations, you kind of
Mhm.
have a little bit more comfortability with it.
Gotcha. Is there a particular, when you think about Atlanta a little bit, um, gosh, how far are people commuting to get to city center now? It's got to be over an hour, right? Are those areas that you're more
Mm.
targeting, or is it closer to city center?
It's no, we're on the outskirts.
Okay.
So the last one we're south of the airport. So that's
What about you?
it's about like an hour away or so. I mean, Atlanta traffic is nuts. I think Atlanta traffic is worse than LA traffic,
Yeah,
because it's like one freeway, one whatever roundabout, and no matter what, you're just stuck.
yeah, I think they've beat Boston in terms of the worst traffic. I got Boston in that number one spot, and I think they've been bumped
Uh,
by Atlanta. Yeah, there's nowhere to go, and it seems like does that
yeah.
concern you at all being in the market? It doesn't seem like there's an ability there to. They really need a rail, right, above ground rail, and it doesn't seem like they have the ability
Mhm.
to do that. Is that concerning to you guys at all? Just some of those transit times?
I mean, but there's still jobs around, so it's not
Yeah.
the similarities from LA to Atlanta
Mm.
is it's not all centrally focused. Everyone doesn't work in one location, so it's spread out. There's jobs everywhere. So out here in Southern California, um, I got my drive time in my commute from where I live to where I work, kind of down pat.
Mm.
It's so I'm not commuting, you know, 2 hours to go one direction, anything like that. Similarly, I see that.
Gotcha. You can work your way around that. And then, how do you think about looking at Indiana? It seems like you could do more value add in that sort of setup, maybe more similar to LA.
You can. So some of the Midwest properties, Well, you have different vintage classes depending on where you are
Hmm.
in the cities. So you can get some old buildings in Atlanta. I mean, the places we're investing in, I'm sorry, you can get old vintage in LA. The places we're investing in Atlanta, we don't, there are old buildings, but not necessarily in the areas where we're investing in.
Hmm.
Likewise in Indiana, although I take that back, Indiana can have some old buildings. So some of those brick buildings can last a whole heck of a long time. Um, but again, out of those markets, we're not looking for such heavy lifts.
Gotcha.
We're looking for minor renovations, getting into the emerging markets, and quite frankly, looking for good deals. I mean, people talk about the Midwest, and I'll explain to you what I mean by good deals. People talk about the Midwest as going there for cash flow, but there's still value add. You can still build profit. Maybe not in kind of like the kind of like when people think about like the classic. Okay, I'm just going to go buy a 3-2, somewhere to get cash flow. That's when people think about the Midwest. Okay, yeah, you can buy a place for 300, $400,000 and maybe get $3,000, $4,000 in rent, whatever it may be.
Yeah.
But you can there is value add. I mean, there's deals, and we've been lucky to find sellers who have been um, willing to deal and negotiate and find properties. So we're shopping, so we're looking.
As a heavy Midwest investor and coming to you obviously from the Midwest, I would nod my head in agreement. There's definitely opportunities and overlooked opportunities here beyond that straight sort of cash flow.
Yeah,
Can I have you define a term or how you define a term for me for a second?
yeah.
I want to make sure people understand core plus is something you
Oh,
said a
okay,
couple
sure.
times. Can you define that for
Yeah, yeah,
folks so they know what that
yeah,
means?
yeah. Yeah, so think about, I'm actually trying to think of what's below value add. Oh, speculative. So
Sure.
you can kind of go on a scale of things from speculative to value add to core plus to core. And
Mhm.
it tells you kind of how stable a building is.
Mhm.
So if you're going into a core building, if you will, and it's actually defined in multiple different ways. But if you're looking, well, actually, we'll talk about big multifamily. So if you're talking about a core property, say like a 200 unit core property,
Mhm.
that's something in an A class neighborhood. That's something that a REIT is going to buy or BlackRock is going to buy. Something that is just coupon cutter, down pat, that it's sealed and it's tight and it's functioning. Core Plus is getting to that, but you may need to do a little bit of work. Maybe it's a little bit more vintage. Maybe it's a 1980s building or 1990s building, but you want to bring it up
Mhm.
to modern day counters and colors and dog parks and amenities or even like technology.
Mhm.
Value add is just taking more. It's there's more of a disconnect because remember, the real estate market by definition is inefficient. It's not the stock market, which is run by Wall Street and SEC. Well, real estate it does have SEC rules on it, obviously, but it's still an inefficient market in terms of how it's run, who's running it, what are the rents and all that kind of stuff. So that's when you kind of look at for those inefficiencies in a value add. Maybe it's an owner who hasn't been raising rents for 5, 10 years, and you're like, oh wow, okay, this is going to be a great opportunity. Those are the kind of stuff that we're looking at. Maybe it's simple of painting a building and making, getting the rents up, or maybe it's the other things I was describing. Let's take advantage of square footage. Let's add some storage that we can rent. Let's add some parking or rent for parking. And then when you start getting lower than that, it's kind of speculative. Like, you know what, I'm going to buy this building and I just think it's going to work, you know, which is as a syndicator, that is really, really super risky.
Yeah.
So those are kind of the terms I'm using.
Gotcha. No, that's very helpful. Yeah, the speculative one is going to scare all of our investors. And sideways, right? Regardless of profession, it's very scary. Is it harder to
Well, and, and,
do?
and, and
Yeah.
actually,
Okay.
actually, let me back up also.
Yeah,
So
please.
it's also in terms of speculation, it's also how you run the building too. So you can buy a 300 unit speculative building and I'll use an example like, in our industry, earlier this year, the sponsors who um, went belly up in terms of
Mhm.
all the properties they owned in Houston, there was a lot of risky moves made there. It was a property that had very low occupancy, with low interest but floating debt.
Hmm.
Now we look at that in retrospect, or even back then, it's not something we wouldn't have done. But I consider that speculative.
Mm.
That you might be showing that, hey, investors, we can give you good returns. There's a lot of speculation. There's a lot of like hoping that things would work in that situation. So that also fits in the speculative realms. And like you were saying, like what I'm saying, when you bring investors, man, that's not your money. That's
Yeah.
other people's money.
Yeah.
Like, do what you want with your own. Go play stock markets, or go hang out in Vegas. That's cool, but not with anyone else's money.
Yeah, it's sort of brutal to sort of watch those situations in Houston. And yes, it's not something that we would say yes to either, because we see the same trappings that you do. And eventually this comes down to, I need to make this entire business plan work, or I have to give the building back. Like those are the two optional, those are the two outcomes. And they're
Sure.
easy for us. I think they're easy to see. And I'd be curious your
Mhm.
take on it too. It's easy to see when I see an overtly optimistic business plan, but that's not even the biggest problem. It's always the debt. The debt's always the
Mhm.
issue. And when we have debt that we absolutely have to refinance in X period of time, that presents a tremendous amount of risk. Do you sort of look at it
Yes.
the same way, or do you have a different sort
Yeah.
of take on it?
Yeah. Yeah. For sure. For sure. I mean, this is a challenge to investors. It's like a lot of what I talk to investors is, well, always talk about the safety of the deal. I never lead with the rewards. It's always the safety of the deal. But B, for an investor has to really trust the sponsor and what they're doing. And that's key. Quite honestly, it doesn't matter for the investor. It doesn't necessarily matter if my building is in LA or in Atlanta or
Mhm.
Indiana. It's like, how do I perform? How does my team perform? Can we keep this business plan running, or is it going to run amok? And if you're in a situation as a syndicator, and you brought up in the Houston deal, you said it was a binary result.
Yeah.
Either it works or you give the building back.
Mhm.
Those are two extremes, huge extremes. Now, if this was angel investing and someone said, okay, I have to start a company and I've got the next Google or something, you can you that's a more acceptable realm of investing.
Mhm.
If someone is going in as an angel investor, they recognize they can lose their money or not. But
Mhm.
if you're going into real estate that's protected by an asset and all the things we teach about real estate, to have a binary options is very, very, very risky.
Yes, it's totally unacceptable to us. I mean, I want deals where the six biggest things can go wrong and I still have preservation of capital and some level of return. That
Mhm.
makes me feel really good. And even on the angel investing side, if we think about the way those funds are structured, they expect to fail. And so they're taking
Yeah,
multiple swings. We're not
yeah.
buying one company, we're buying hundreds of companies and hoping we find five that work out really well. And that's going to make a return pattern for us. So even in that construct, they're mitigating risk for
Yeah,
things to go wrong, right?
good
So
point.
like
Yeah,
when there's
for
when
sure.
there's no outs, man, it's like it's either a home
Mhm.
run or it's I'm getting kicked out of baseball. Like those are the only two options there. I just don't have
Uh,
much of interest in that. Um,
yeah.
how hard is how do you approach sort of value add as our friend Jerome Powell, as we refer to on the show, our best friend Jerome, um, has shifted the board on us. How does that shift the way you guys look at value add? Because the game has changed a bit, right?
Yeah, yeah, yeah. So what you're referring to in terms of shifting the board is how the interest rates have changed dramatically over the last several quarters.
Mhm.
And so our internal team and the economists that we follow is what we're looking for is stability. In an unstable situation, it's hard to make estimates on how your business plan can work. And like earlier, I talked about, it's like when you're underwriting, every number is a row and a column in which you insert. And so you have to make, in your business plans, you have to make judgments on what may happen in the future.
Mhm.
And if you don't have guidance in terms of interest rates, and again, like you were talking about earlier, in terms of the risk of a deal, a lot has to be on the debt structure. So if you don't have guidance in terms of where that's going, it is harder to anticipate what your business plan is going to run at. So we strongly feel that once there's a point of stability, or where there's a voice that there's going to be stability in the interest rate, we see that that's going to allow people to know how to underwrite these deals and start to come out. We should start to see more activity, more transactions happening, more trades
Mhm.
on the seller side and on the buyer side, because then we can know what we're dealing with. We see more cards, if you will, and that we can go. People still need to sell. People still need to buy,
Mhm.
and it's just this change in interest rate has kind of put a pause on things more because of the instability.
Mhm.
The interest rate doesn't matter so much if it's 6% or 5.5%. You just have to know what you're dealing with.
I got you. Yep, exactly. And it also seems like, and you again correct me if I'm wrong, but it also seems like as we hit these periods of instability and interest rates, our lending friends get a little tighter with the purse as well. Is that a challenge that you guys have sort of had to navigate through of gain access to debt or
Yeah,
favorable debt?
yeah. So not only is it the interest rate, but yes, what's available? How many dollars are available out there? We strongly feel that private equity, raising money becomes even more critically important. Family offices, if you will, stuff like that. But yeah, the banks have are stricter, if you will. You got to find a better deal, and you got to keep shopping. And again, if you're sticking to your fundamentals, if you're sticking to your metrics, if it doesn't mean you didn't buy a property last quarter, it's okay. Keep
Mhm.
shopping.
I gotta concur. Is I think we've started to separate. We always separate our smartest, syndicators and folks that operate in this space, and all of them seem to be a little bit more quiet and hunting
Hmm.
more. And you see less and less deals. Some
Hmm.
are just completely silent, and they have been for a
Hmm.
while as they wait for a deal to come. It's that kind of patience will be rewarded. We think for sure. Um,
Yeah, I agree.
how do you think about and sort of approach as we watch this market? Are you seeing? I sort of have a theory on the distress that we're seeing or maybe not seeing.
Mm.
Are you seeing any of that distress hit your desk? And as you look at some of those opportunities, do they become attractive, or is the distress that I think some people are anticipating just not happening?
Yeah. So what you're referring to in distress is, and correct me if I'm wrong, obviously, but what you're referring to is the deals and the sponsors who had floating debt and are now forced to refinance, and they don't have the equity stake to to do it.
Yeah.
So either they're
Yep.
yeah. So that, are they going to give up the building? Are they going to sell at a loss? What's going to happen? I don't think it's going to be kind of how the media represents it, that it's like doom and gloom, right? That the red tide is going to come in. That you're going to see all these um, dead animals washed up on our beaches. I don't think it's going to be that grotesque. I think there are people in trouble, and there are going to be people in trouble, and I think deals are just going to be made. And I don't think they're necessarily going to hit the public eye, because brokers are going to be calling around, "Hey, I've got so and so. This is their deal. You know, are you able to close this?" Stuff like that. That's what I think it's going to be, as opposed to them all hitting the open market. I could be wrong, but that's kind of what our guidance has been.
Yeah. Thank you, because now this is confirming my thoughts, so I'll make feel good
Uh,
about that. Yeah, I just feel like, and I'm gonna use sort of what you said earlier. There's still a lot of money hanging around, and
mm,
when there's still a lot of money hanging around, you don't get a distress situation, or
mm,
there's already it's like a deli line. They already got the numbers. Like the people at the front of the
uh,
deli line, it's not Brandon Bruckman. I can guarantee you that, right? So,
uh,
just not, you said it, like the transactions are just going to happen, and we're just not going to see them. We'll read about
mhm.
them later when they happen with the key here is to get in front of the deli line. If you if you can find
Yeah,
a way to get in the deli,
I like the
there,
deli
there-
example. That's
yeah,
good.
there might be if you got number
Uh,
6, man, you might be doing all right. You can find some opportunities, but if you're
uh,
waiting around the block, like it's just probably not going to happen for you. But it's out there. This has
mhm.
been great. What else? What else would you like to add for our listeners? What am I not asking that I should be?
I think you're asking all the right questions. I mean, we talked about whatever sponsor you're getting in, those who the investors who are listening to this, is you got to know your sponsors. I mean, you really gotta. It's almost better going out to dinner with a sponsor and knowing who they are, as opposed to knowing the deal. That sounds so stupid,
No way.
but it's like you got to know who you're dealing with. There's always going to be transactions. Real estate is still a fantastic asset value to get involved with. It brings you a lot of freedoms, and it's like once you figure out what your freedoms are and what you're searching for in your kind of the content, what you want in your life, this is a great way of doing it. And there's people like us out there. You know, we're here to educate, we're here to teach. Most of my phone calls are more about education, and sometimes we steer away from real estate as I kind of try to guide them in one way or another. So it's good. Come out and meet us. We're easy to meet. We love to talk.
Yeah, man. Yeah, exactly. And I would second that knowing the sponsor is critical. And hey, there's great sponsors, and we know them well enough that we can say, hey, this deal doesn't really work for us. Here's why. And we can have really good conversations about it that way, as opposed to someone you don't know, and you really can't have. It's hard to have that conversation about what that might be.
Yep.
And you can kind of make those adjustments. So I'm 100% with you there. What's the best way for folks to get in contact with you?
Yeah, so I'm on LinkedIn every day. So if you send me a message on LinkedIn, I guarantee you I will respond. In fact, that's how almost everyone gets in touch with me. So Sanjay Sharma, MD, come and friend me on there. You can email me directly at sanjay.sharma@excapinv.com. I promise you I'll answer my email. In both ways, you can just set up a phone call if you don't want to email or friend me. There's a calendar link where we'll set up a phone call and talk. You can come on my website, www.excapinv.com.
That's awesome. Yep. And if you're watching on YouTube, both of us have our contact information right on the screen. So we've figured out how to do that, and it works really well.
Yeah.
That's awesome. Hey, thank you so much for taking time out of course, your busy day to join us. We really appreciate it.
It's been great. It's been an honor to be here. I love talking to you.
Awesome. Thanks so much. And thank you all for listening. Until next time, we'll see you.